Hi, and welcome back to the Business Career College video series. Again, this is Jason Watt, and in this video we're going to be looking at the tax-free savings account. And this is actually a pretty basic instrument, this tax-free savings account. What it actually is, it's a tax measure. So the tax-free savings account comes about as a result of Section 146 of the Income Tax Act, which provides that you can invest here. And exactly as the name implies, you can have tax-free returns as long as you follow the rules laid out for how much money you can invest and what sorts of investments you use, which is easy. There's nothing to that. The rules are well defined and there's a broad set of investments available. And tax-free withdrawals. So the name tax-free savings account, at least the first portion, tax-free, is quite appropriate. Savings is sometimes a little bit misleading because this leads people to think that you can only use a bank type savings account here, when in reality a huge variety of investments are available. Similar to the RRSP, you could use, for example, stocks or bonds or mutual funds or segregated funds or GICs or a bank account. Lots and lots of different stuff here, and even some more exciting stuff, but that basic stuff is going to cover most people's investment needs. So lots and lots of different options here. Now, when you put money into a tax-free savings account, it is a little different than when you put money into your RRSP. There is no tax deduction associated with contributions to a TFSA. Essentially, you're contributing here with your after-tax dollars. So what are the requirements to participate in a TFSA? What do we have to do? Well, the TFSA was introduced in 2009. And when it was introduced in 2009, we said, okay, in order to participate, you have to be at least age 18. You can participate in a TFSA as of your 18th birthday, and you have to be a Canadian resident. So pretty easy criteria to meet. Unlike with, let's say, the RRSP, there is no income requirement in order to participate here. So minimum age 18, Canadian resident. And when it was introduced in 2009, the contribution limit for that year into the TFSA was $5,000. And again, in 2010, the contribution limit was $5,000, but it's not $5,000 alone, it's $5,000 plus any unused 2009 room and plus any withdrawals made in 2009. We're going to walk through a little example of that in a moment. And that's important. That's exactly the right wording. This is exactly how the TFSA actually works, your unused room and your 2009 withdrawals. So if you were 18 in 2009 but didn't set up a TFSA in 2010, you would have had $5,000 from 2009 and $5,000 plus 2010, a combined $10,000, of TFSA room. And then in 2011, same thing. You would take your unused 2010 amount. Your new $5,000 plus your unused 2010 amount plus your 2010 withdrawals. So again, if you were starting one for the first time in 2011, you would have $15,000 of room as long as you've been a Canadian resident and 18 years of age at least since 2009. 2012 gives us a very similar set of rules. Another $5,000 plus. And then, of course, 2013 is when we see the first impact of a set of rule changes around the TFSA, when we have now $5,500 of contribution room, again, plus. And in 2014, we still are at that same $5,500 of contribution room plus. So if you're starting a TFSA for the first time ever, today in 2014, and you have been a Canadian resident and at least 18 years of age since 2009, you would have 5,000 plus 5,000 plus 5,000 plus 5,000 plus 5,500 plus 5,500, a total of $31,000 of room available. Even if you had never set up a TFSA, the requirement is only, as I've said numerous times now, that you're a Canadian resident at least age 18. Now, we don't know for sure, what the 2015 contribution limit will be. What happens here is the $5,000 is set to index to inflation. So when that sort of background indexed figure gets greater than $5,750, I guess technically greater than or equal to $5,750, then we will have a $6,000 TFSA limit. We don't know if that'll happen yet. That's adjusted for inflation to match the consumer price index each year. So only if CPI shows us that this should increase will it actually increase. So we might have $6,000 of room in 2015, or maybe we have to wait until 2016 or 2017 to see that. So now let's just rewind a little bit here. We're going to go back to 2009. We're going to look at some examples of what might have happened here with this thing in 2009. So here we're going to have person A. And what happened here is person A put $5,000 into their TFSA. They bought stock in a company early, or shares in a company early in 2009, and it grew to $8,000. So they did very well. $5,000 in grows to $8,000. And then what they did is they said, well, I'm going to take that $8,000 out and spent it. So they took that money out of the TFSA and they went and spent it. They bought a car, or they went on vacation, or whatever it happens to be. So this person who took $8,000 out, now in 2010, if we follow through this formula we see just above here, they would have $5,000 of new room. They have zero unused room from 2009, but what they do have from 2009 is $8,000 of withdrawals. They could, as of January 1st of 2010, have as much as $13,000 in their TFSA. They could put their $5,000 in related to their 2010 new amount and their $8,000 in related to their 2009 withdrawal, which is exactly the same thing that would have happened had they just left the $8,000 in there and then made their maximum possible contribution on January 1st. So very straightforward that way. Now, let's look at a different scenario here, and we can see this is a little bit of a double-edged sword, but it's not really any sort of magic here. So now this person B, puts $5,000 in. Again, same thing. They go out and they buy some stock in a company, and that fell in value to just $2,000. So they really didn't do very well with their investment here. They got frustrated, made probably a bad decision. They took out that money and spent it. And now they would have in 2010 $5,000 of new room plus no unused room from 2009 plus their withdrawal from 2009 of $2,000. This person would have the potential to have as much as $7,000 in the TFSA on January 1st of 2010, which again is exactly the same as if they had just left that $2,000 in there, wrote it out, and then added a new $5,000 on January 1st. So again, no magic. Now, a couple of other things to look at with the TFSA. So you can take withdrawals anytime. Anytime you want. You can take them out tax-free, as we've said earlier. And there's no forced withdrawals ever. So unlike the RRSP, which is going to eventually cause you to have to mature it when you get to December 31st of your 71st year, Here, the TFSA doesn't compel any withdrawals at any age. Now, there is the possibility of over-contributions to the TFSA. This was actually a very common problem in the early years of the TFSA. And what happened here, so in 2009, for example, let's say that I put $5,000 into my TFSA, and then through the year, I took money out and I put money back in, and I took money out and I put money back in, and my balance never exceeded $5,000. But periodically, when I put money back in, let's say that this person, just to keep it easy, took $500 out, put $500 back in, ended up with a total of $5,000 at the end of the year. But in fact, they put in, we can see they made $6,000 of contributions to this TFSA over the course of that year, 2009. That $1,000 over here, the two $500 amounts, would create an over contribution, and there is a penalty tax on that over contribution. Two penalty taxes in a sense. It's first off a 1% per month penalty on the amount over, so there's a tax applied there. And then the second part of this is that the returns that you generate on that, now this is subject to some discretion, but the returns are 100% taxed. Now that hasn't always been the case, but that is the case today with the TFSA, that if you deliberately over-contribute, your returns are 100% taxable. That means if you make $1 of investment income, you're going to pay $1 of tax. Now the last thing that we'll look at here is the TFSA on death. Still, it's a very simple plan, and really, on death, there's no different treatment here than what we're used to with most registered plans. It's still tax-free at death. No tax to pay here. You can name a beneficiary. And then basically what happens here is this amount would bypass probate, as with any other beneficiary designation. We're going to be able to bypass probate, so we're going to go straight to that beneficiary with this money, and as we probably suspect, there is no tax to pay. That's easy. And you can name any beneficiary at all. No restrictions on who you name as beneficiary. So there's just one set of exceptional circumstances here, and this is with a spouse. So here you can name a spouse, not as beneficiary now. Properly, you would name your spouse as your successor owner, or sometimes we would refer to as a successor annuitant. It depends on the province that you're in, but they're the same thing. And this can only be your spouse or common law partner. These are the only people that get this treatment. So only your spouse or your common law partner. And what happens now is your TFSA essentially becomes theirs. Oops. Your TFSA rolls into their TFSA. They don't need any room to absorb it, and this doesn't use any of their room. There's no spousal TFSA contributions posthumously, unlike, say, the RRSP, where you can do that. You can actually, after the death of a spouse, you can still have some RSP contributions made. No such thing with the TFSA. So I hope that helps. It's a very basic plan. That's one of its big appeals. It's very straightforward. You put money in, it grows tax-free. You take money out, it's tax-free. So this is something you're going to have to know for pretty much every financial services exam today. I hope that it helps. And we will examine in a later video the relationship between the TFSA and the RRSP and other sorts of savings opportunities, and how you integrate those into one big tax planning strategy. I hope that helps. Enjoy your ongoing studies. Thank you very much.